What if I told you there are legal ways for taxpayers like yourself to pay $0 in income taxes? And by zero, I mean not a single penny. Well, you might be tempted to think that sounds impossible, or this is just too good to be true. But over the last 25 years as a licensed CPA, I have helped many of my clients follow these 5 simple tips, and they have proven to work every time. Now, in this video, I am going to share with you the exact 5 tips my clients take so you can learn how to keep all your money rather than give it all to Uncle Sam. Now, let's get started. So the first tip to help you eliminate your income taxes is called controlling your income. Now, we would like to think that we control our income, but very few people actually do this correctly. Here's the mistake we make. We get paid on payday. Our taxes are automatically taken out of our check. We look at what's left in our check after taxes, and then we feel like let down, disappointed because we donated all that chunk of money to Uncle Sam. This experience leaves us feeling powerless, but it does not have to be this way. The good news is that we can make changes to fix this. With the controlling your income strategy, you will be able to strategically reduce your taxes by decreasing your taxable income. And this means more money in your pocket. Now, for this strategy to work, you will need to have a business or you can start a brand new business. Either is fine. Let me give you 2 real-world examples of how this works. Here's the first example. Imagine you're running a restaurant and you're going to profit roughly about $150,000 for the year. To lower your taxable income, you make 3 big purchases for the business. First, you upgrade the company vehicle by purchasing a refrigerated delivery truck that cost you $70,000. Next, you purchase a $40,000 specialty oven. And lastly, you buy a commercial grade refrigerator for $40,000. When you add up the expenses of the truck, oven, and refrigerator, they total $150,000. With the controlling your income strategy, we leverage Section 179, which allows business to take an immediate deduction for business expenses considered depreciable assets. In our example here, we had $150,000 net profit, but we planned correctly. We purchased the $150,000 of upgrading equipment to better our business on credit. And that leaves us with 0 tax bill for the year. This follows our plan of controlling our income perfectly because we will not have to pay any taxes, not a penny. Now, let's move on to our next example. Let's say you do not have a business yet, but you want to make some extra income with a side hustle. The new business will make its money from TikTok by recording and posting entertaining videos. You find a place to do the recordings and you set it up. For your recording equipment, you'll just use something basic like your current cell phone. By the end of the year, you make $1,000. TikTok sends you a 1099 for that amount. So how do we control this income? First, you write off $500, the setup, even if the setup was previously an existing living room. Next, you claim your cell phone, and your cell phone cost you $500. So with your new business venture, your business extra cash you just made is not brought down to $0 for taxable purposes. So for tip number 2, ever wonder how the ultra-rich pay minimal taxes? For tip number 2, we are going to take a page from one of Bezos' books and learn how to leverage debt smartly while decreasing taxable income. The Bezos strategy involves taking out a loan on assets with tax-deductible interest, like real estate, for example. By doing so, you can use the untaxed profits to pay back the loan. This is what is known as a collateralized loan. So here's a practical example of how this works. Let's assume you take out a loan for $50,000 at 5% interest against some real estate that you own outright. So at 5% interest, this loan would cost you $2,500. And now you take the $50,000 that you took out in loan and you invest it into the market and earn about 10%, which is about $5,000 on your investment. When you take the $5,000 you just made from your investment and subtract the $2,500 for the cost of the loan, that leaves you with a $2,500 profit. But wait just a minute. What it looks like a $2,500 profit is actually wiped out by the depreciation on the real estate that you took out the loan against. So the net income on your tax return is now 0, but you personally just made $2,500 cash. This sounds a bit risky, and it is. With the profits of the investment money, you pay back your loan with untaxed money. Normally, these are collateralized loans and have a lower interest rate. And Normally, the interest is deductible for the business. This happens to be one of my favorite strategies that Bezos uses, and I use it personally. On to tip number 3, unearth hidden deductions. In my experience, some of the biggest missed tax savings often lie in the details. By combing through your business activities and receipts, you might uncover hidden deductions like home office expenses, travel costs, or fully depreciable vehicles. As you can imagine, all of these deductions can significantly lower your taxable income. Now, whenever I take a new client, I always recommend starting them off with a tax savings plan. With the tax savings plans, we get into the finer details of their daily activities. Whenever we do this, without fail, we find hidden deductions that were not accounted for. In fact, in a recent tax planning session, we saved one of my most recent clients $115,000 by going over their everyday business activities. The business traveled a good bit around the country because they would serve food at major fair events. While discussing their business activities in detail, we found that they never paid per diem to the owners nor the employees. And for those who do not know what per diem is, simply allows to take a daily allowance that employees or owners receive to cover their business-related travel expenses. This includes items such as lodging, meals, incidental costs. As you can see, hidden deductions can be a big part of lowering your taxable income. And it is important that you get help analyzing your business and how you're running and to make the most of these hidden deductions. Tip number 4, investment funneling. This is another one of my favorite income strategies of the rich. This works best when you understand how to time your income from investments. Let me explain. It often comes as a big shock to most people that not all investment is created equal. With investment, it is very important to understand the key difference between long-term capital gains versus short-term capital gains. By definition, with long-term capital gains, you must hold your asset or investment for 1 year or more. And for short-term capital gains, you hold your investment for 1 year or less. Now, long-term capital gains have their own income tax rules, and they are very nice. Depending on your income, you might not pay any taxes at all on capital gains up to certain threshold. For example, if you sell up to $47,025 worth of stock that you had long-term and you don't have any other income, you will not pay any income tax on the $47,025 in 2024. Now, that is a really nice benefit. I have clients who sell stock all the time, and if we time it to the year that their income is low or none at all, we can eliminate taxes altogether. Tip number 5, real estate riches is my favorite. By deducting expenses like mortgage interest, repairs, depreciation, you can turn your rental income into a tax-free or tax-deferred revenue stream. Plus, if needed, you can leverage property equity to access tax-free funds through loans. Real estate isn't just about property appreciation, it's literally a gold mine for tax benefits. So how does this work? Let me give you an example. Let's assume you bought a $250,000 home and you rent it at about $2,600 a month. This adds up to about $31,200 in gross revenue from just one rental property. From there, you deduct your mortgage expenses such as interest, property taxes, homeowners insurance, maintenance. So if we assume that you spend $22,200 in expenses for the year in your rental property, and now the depreciation is about $9,000 for the year. This leaves you with zero taxable income. With that being said, just imagine if you had 4 properties that would give you $36,000 in annual income and you would pay 0 federal taxes, not a penny. Now remember, along with these and with most saving strategies require time, diligent planning, and often professional assistance to navigate effectively. With a little know-how and strategic planning, you can live tax-free and you will be able to keep more of your hard-earned money where it belongs, in your pocket. Now, as always, be sure to consult with a financial advisor to make the most of these tax savings opportunities. If you don't already know me, my name is Sonia Advice. I am a licensed CPA and wealth building strategist with over 25 years experience. If you have any questions about how how to take advantage of these strategies and how to decrease your taxes, don't hesitate to contact us. To get your free complimentary consultation with a member of my team, simply click the scheduling link in the description below and pick the time that works best for you. We would love to help and meet you. Lastly, be sure to like and subscribe to get more content just like this. By doing this, you will help other people discover our content. The more you help us grow this channel, the more free content we can provide to you. Until next time, have a great day, and I look forward to seeing you soon.